In this video, I'll go through 4 of the best current performing ETFs that you can invest in, and each have provided outstanding recent 1-year returns, and this has continued into 2025. In looking at each, I will go through various useful factors that I think will be important to you with your research, such as risk, costs, performance, and fund diversity. And I will display a fund comparison chart on screen as we go through them. As always, I need to remind you that what is covered today is not necessarily my recommendation, and it is not financial advice. This is a financial education video to help you with your research to find something that suits your personal circumstances, fact check what I or anyone else tells you on YouTube, and seek advice from a financial professional if unsure of anything before you invest. So let's kick off with the first high performing ETF, which is the Amundi MSCI China UCITS ETF with a ticker of LCCG. This is an accumulating ETF, meaning that any dividends paid to you by the companies in it automatically get reinvested back into the ETF for you in the most efficient way. This keeps things really simple and means that you don't have to do anything else other than invest regularly. Funds often have distributing or income versions also, but in those cases, you would have to reinvest those dividends manually and therefore less efficiently. And this also then adds an additional moving part that you might not want if one of your financial objectives is keeping things simple for the longer term. Passive funds try to replicate the aggregate performance of an index of companies and can have different methods of achieving this. Synthetic replication is used in the case of this ETF. This involves a counterparty, such as a bank or other established financial institution, promising to pay the index's performance for a fee. This is also known as a derivative or swap. So in this case, there will be a small risk of the counterparty failing to fulfill those obligations. This is not something that I would personally lose sleep over, but if you want to know more about this, then please shout out in the comments below. The total expense ratio, or TER, is the charge that fund provider Amundi makes for its administration. This is also referred to as an OCF or ongoing charge figure on some other sites. The TER for this one is 0.29%, which is higher than many developed world ETFs. For example, ETFs that track the US's S&P 500 index of the 500 largest US companies can be as low as 0.05%. When investing in ETFs that lean towards emerging markets, these fees tend to be bigger, with less liquid stocks in less developed regions where markets are more fragmented. And keeping costs to a minimum should be an overall consideration for you when doing your research. This ETF tracks the MSCI China index, which consists of the largest and most liquid China stocks, and it is traded in sterling on a London stock exchange, so foreign exchange fees are kept lower. There are alternative versions of this and other funds featured, traded in different currencies on different stock exchanges. So do your research on which one suits you best in your country of residence. And there are 582 holdings in total, with the top 10 accounting for about 48% of this index. The biggest sectors are consumer discretionary, telecommunication and financials that account for about 60%. All of the ETFs featured in this video would be constructed on a market capitalisation basis, meaning that a company's size will determine the percentage it takes within the index. For example, in the case of Tencent, in this one, it is the largest and occupies 16.37%. So every share you purchased in this ETF would consist of 16.37% Tencent. A primary aim of ETFs is to give investors a level of diversity above what you would get from investing in a single company, and to manage the risk of your portfolio being too concentrated on too few investments. But don't assume that the ETF that you have chosen will give you a level of diversity that suits your individual risk profile. And it's important to look at the portfolio statistics to give you a better understanding of what diversity the ETF achieves. For instance, with this one, you could argue that it achieves good diversity with a lot of companies across various sectors. That then balances out the risk of some companies or sectors underperforming. But all these companies emanate from one region, so the country's economic performance and the decisions its government makes could impact greatly on your portfolio's value. This is even more the case where the region or country concerned is considered to be part of emerging markets, where there might be more instability and unexpected government policy introduced. Also, only 10 companies account for nearly half of the index year, so they will have a big influence on performance. These details are important to research and matters for your consideration. Volatility figures that research sites such as CHTE provides can give you an idea of how risky an ETF is. A higher number represents a wider and more frequent price movement of your investment, and the higher likelihood of you not getting some or all of your money back. And these volatility figures often tend to reflect the diversity of the fund in question, with higher volatility often being caused in big part by exposure to fewer and more similar stocks, as these next figures show. If you take a single stock from this index, using Tencent as an example, you can see that there is high volatility from 100% concentration in one stock. With a fund of 582 companies in total, the volatility, although still high, is now 1 year 25.34% and 3 years 26.31%. If choosing a region-specific fund away from emerging markets, such as the United States Vanguard S&P 500 UCITS ETF, you get a much lower 1 year volatility of 15.27% and 3 years 18.22%. But when you zoom out and look at a more regionally and globally diverse fund, such as the Vanguard FTSE All World UCITS ETF, you get even lower volatility figures. So comparing volatility data with other funds, alongside data such as holdings, regions, and sectors, could help you to get a better understanding whether the fund suits your needs. Year-to-date performance is very good, with the ETF achieving 14.05% gains so far since January. 1 year performance is also very impressive at 39.07%. To put that into perspective, 10,000 invested as a lump sum a year ago would have given you a substantial gain of £3,907. Not all of the funds featured today are mature enough to give you 5 or even 3 year performance figures, and this longer term data would be useful to show more accurate consistency of the fund. That said, past performance figures are not a reliable indicator of what will happen in the future in any case, even if taken over longer periods, and such data should be used for guide purposes only. And if you are enjoying this video so far and finding it useful, then please hit that like button and consider subscribing to my channel and to turn on notifications so that you'll be aware of when I post new content. The good short-term performance of this first fund is bettered by the second one that we feature, which is Invesco MSCI China Technology All Shares Stock Connect UCITS ETF with a ticker of MCTS. This is an accumulating ETF once more, using a slightly lower risk full physical replication methods of tracking this index this time, where the ETF buys all the securities in the index in its exact proportions. It has a bigger, more expensive TER of 0.49%. Is this too expensive? A consideration for me would be the proportion of your portfolio that it takes, and then weighing up the costs against those expected returns. If this ETF occupied just a few percent of your total investments, 0.49%, that smaller percentage, might be more palatable for the return you hope to get from it. The ETF seeks to track the MSCI China Technology All Shares Stock Connect Select Index. This is an index of Chinese companies active in the development of new products and services associated to technology innovations. And this one is sterling hedged and traded on the London Stock Exchange once more. It has 100 holdings, with the top 10 accounting for a bigger 60%, with a bigger tilt towards the technology sector, which, along with the largest sector of consumer discretionary and the third biggest telecommunications, accounts for 76% of the index in total. With the reduced diversity comes slightly higher volatility figures, and therefore slightly higher risk, with 1 year figures of 25.27% and 3 year figures of 28.16%. With this higher risk comes the potential for greater rewards. The year-to-date figures are a healthy 15.89%, and the fund has returned 42.61% in 1 year. That is a £4,261 gain if you invested £10,000 as a lump sum in March 2024. But the returns get even better when looking at the next fund, which steps away from Chinese stocks to focus on more specific industries in fewer sectors, and is the VanEck Defense UCITS ETF with the ticker of DFNG. This is again an accumulation fund using full physical replication to track its index. The TER charges are higher again at 0.55%. The ETF seeks to track the Market Vector Global Defense Industry Index, which tracks the performance of companies worldwide that are engaged in military or defense industry. It's again pound sterling hedged and trades on the London Stock Exchange. It has a smaller 28 holdings, with the top 10 occupying 63% of the index. It is, however, the most regionally diverse ETF so far, with the US accounting for 59%, but with countries in Europe and Asia also taking significant market share. 1 year volatility figures are lower than the first two funds at 19.39%. This is a newer fund, so there's no 3 year figures available. The year-to-date performance figures are a higher 19.23%, with 1 year performance being a very large 45.74%. That means that £10,000 invested as a lump sum last year would now give you £14,574 in total. If you think that many governments are going to increase defence spending over the next few years, in this new era of global instability, then this one could be worth researching more. The last fund featured in this video has provided the biggest returns of all those we have spoken about in this video. And we return to China for this one as we look at the UBS Solactive China Technology UCITS ETF with the ticker of CHTE. Like all the others, this is an accumulation fund and once again uses full physical replication to track its index. This is a smaller fund with assets under management of about 48 million sterling. The TER for this one is 0.47%, smaller than the last but still quite expensive. The fund seeks to track the Solactive China Technology Index, an index of the 100 largest technology-driven Chinese companies, which are primarily active in innovative business fields such as cloud computing, medical technologies, future mobility, and digital entertainment. Once again, you can find this fund traded in sterling on the London Stock Exchange, and it has 100 holdings, with the top 10 accounting for about 62% of the total index. Telecommunication, technology, and consumer discretionary sectors are the biggest, occupying about 77%. And this one has the highest one-year volatility data of 29.31% and 3-year figures of 32.63%. You would therefore expect higher returns for this additional risk, and the ETF does not fail to deliver, with year-to-date gains of 24.31% and one-year gains of a massive 50%. That's £5,000 on top of that £10,000 that you invested as a lump sum this time last year. From looking at these funds, it can be seen that the defence industry is in a period of significant growth, with the prospect of this continuing against the backdrop of continued global instability, whilst China continues to innovate to become an even bigger, influential player on the world stage. Chinese companies have made some big announcements this year that have caused a stir in financial markets, such as DeepSeek, which promises to compete with established AI chat services such as ChatGPT, but for a much lower price, and electric car manufacturer BYD, who recently unveiled Super E-platform technology, which it says would allow cars that use the technology to achieve 400 kilometers, or roughly 249 miles of range, with just 5 minutes of charging. Both directly compete with well-known tech companies and threaten to increase Chinese global market share at the expense of the US and others. Defence is an easy conundrum for me. Having a longer-term and simplistic view of investing, I will probably shy away from specific investments in more niche defence ETFs, and hope that the smaller exposure I have to the industry within the global funds that I own will give me some sort of reward for the smaller risk that I'll take. But in relation to China, the dilemma is more difficult. A question I must therefore ask myself, with my age and remaining investing timeline, is how long will it be before China moves from emerging markets into the developed market space, and do I then have enough time to benefit? I'm still trying to work that one out, but whilst I don't have the answer, I will continue to include about 3 to 4% of emerging market funds in my investment portfolio as a satellite to my global equities and bonds. Thanks very much for watching.